Hey everyone, me Kevin here. In this video, I'm gonna go through 10 money mistakes that I found that everybody makes, no matter how much money or how little money you got. So I figure, hey, you know what? It's normal to make mistakes, but why not make a video outlining some new perspectives that are going to help you make more money? And remember, this isn't designed to prove anybody wrong. Instead, I just wanna explain some perspectives that a lot of people, when they hear them at first, are like, oh, wait a minute, you're right, that is a good idea. So why don't we give it a shot? Let's get right into it. And keep in mind, I'm my own favorite sponsor. So if you want some amazing programs, check out the links down below. You can get life insurance in as little as 5 minutes. That is a different company though. And you can get 2 free stocks with Webull when you deposit $100. All right, let's get started. Number 1, the biggest money mistake, in my opinion, that is consistently made when folks start managing their own finances is prioritizing cash flow over wealth. And this is really popularized, especially on YouTube, by, well, YouTube creators driving Lambos and driving around going, cash flow, yeah! This is intoxicating because of course it's wonderful to have a Lambo and go, oh, my cash flow pays for this. You realize that's great because it's money that they're making while they're sleeping. But there are a few big problems with passive income or cash flow or dividends. Here they are, especially when you compare them to wealth building. First, something that I teach in my Psychology of Money and Stocks course is you have to ask yourself, what phase of life are you in? There are 2, and only 2. And you gotta ask yourself which ride you're on. Are you in the growth and wealth building phase, or are you in the payoff and then retire phase? For 95% of us watching this video, the odds are we are in the grow your wealth and make as much money as possible to grow your wealth phase. This is why so many of us here, oh yeah, I'm gonna make passive income, but Kevin, don't worry, I'm gonna reinvest that money and I'm gonna grow my wealth even more, yeah. Well, here's the thing. Most of the time when we get cash flow, whether it's real estate cash flow or dividends or from some sort of debt we lent out or whatever, we come up with 2 big problems. Problem number 1, when we receive cash flow, we're really likely to spend it on things that make it look like we're wealthy. And this is normal because when money comes into our bank account, we feel a little richer, and then you know what? It's okay to buy Thor's hammer for $3,000. Okay, this was like $20, but whatever. And it's hard to overcome the urge not to, man, I worked so hard this week, I may as well go to the Cheesecake Factory and buy myself a drink tonight. You know what Lauren and I used to do consistently before the pandemic was we'd bring our own, I don't know if you should do this, but we'd bring our own drinks and just have the drinks there and order food and water. Never saw a problem with that. Don't sue me, Cheesecake Factory. Anyway, it's very hard to overcome when you get money in the mailbox or money by direct deposit, the urge not to spend it. It's actually a lot harder to reinvest it. And yeah, you can automatically reinvest, but that brings up the second problem, taxes. When you're retired, that is when you're in that paid off phase of life, you're generally in a lower tax bracket because, well, you're not making money at your job anymore. See, when you're working a job, you're paying some base taxes, right? When you're retired, you don't have those base taxes anymore, and you can start making passive income and you pay very, very little tax on that first amount of passive income you make. But when you got a job and you're making money, like you and your wife, let's say you're each making $30,000 or you're each making $40,000, or you and your boyfriend, your husband, it doesn't matter who it is, it doesn't matter, right? When you're making money combined, any cash flow you get goes on top of that. And that tends to get taxed at a higher rate. That means every time you get $100 or $1,000 in cash flow or dividends or cash flow from real estate or payments from whatever, the government's coming in going, good job, worker bee, give me a share of that. And I hate that. I would much rather, instead, while I'm working, focus on building my wealth. Because when you build your wealth, guess what happens? You don't have to pay taxes. And in some cases, you never have to pay taxes. Sometimes you sell and you have to pay taxes, but there are ways never to pay taxes, especially in real estate. So, for example, when people ask me, Kevin, should I buy this cash flowing 4-unit property in the middle of nowhere, or should I buy this property that's going to increase my net worth by $150,000 when I fix it up over the next 3 months? But it's not gonna have a lot of cash flow. It's gonna cover its expenses, but it's gonna have less cash flow. Which one should I buy? Well, the answer is, what phase of life are you in? Are you building your wealth? And are you trying to prevent paying more money in taxes right now? Or are you in that retired phase where it makes sense to just double down and say, you know what? I don't need the Tesla and the Apple stock. I'm just going to get AT&T stock and take my 7% dividend. I personally know that I am not in the retired or payoff phase. I'm in the growth phase. I'm in the phase where I'm like, let's go. How big can we make the boat, so to speak? I sold my AT&T stock because I don't want to pay taxes on the dividend. And I'm in California. So if I get $1,000 in dividends, California is going to take about 50% of that money away from me, thanks to the very, very high state income tax along with short-term capital gains tax rates. It's nuts. But don't worry about all that complicated stuff. Instead, focus on what phase of life are you in. You're either building wealth or you're in retired and cash flow. The big mistake that people make is they straddle. They're like, well, I want to build wealth and have cash flow. All right, you're just slowing yourself down because you're sharing your gains with the government. And I'm not suggesting you don't want cash flow. You want some cash flow. So that way if things go bad, at least you have something to insulate yourself, right? But there's a prioritization of how much you really want and where your focus should be. All right, number one, out of the way. Let's get on to number two. Paying off the wrong type of credit. This is gonna be a fun one, and it's gonna make some of you think. And that's the point of this. We're thinking about money here, folks. I'm gonna be thinking about sparkling water here in a minute too, because this sparkling water's been looking at me. I'm choking on myself. Many of you have told me, and many people have shown me their finances and their portfolios and that, and they say they find it to be a struggle to get out of credit card debt. And what I've actually done is, in some cases, sometimes people find that they have student loans and car loans and credit card debt. And every single month they pay off their credit cards a bit, but then as soon as that credit is available, they spend it again. And they never, ever get out of debt. And so this is where it's helpful to know what your personality is. Every time you pay that credit card down a bit, maybe instead of leaving that credit available, you call up the bank and go, yo, I need to lower my credit limit. And that way it seals off, it cuts off the available credit, and now you're looking to pay it off again. You pay off another $500, boom, lower the credit limit another $500. And then I know some people are like, oh, but Kevin, then my credit card utilization is gonna go down. Don't worry about it. If you're paying credit card interest rate debt, right now is not the time to worry about your score. Your job is to pay this debt off. And I don't mean be late on payments. I mean, still be timely on everything, okay? So you do have to baseline worry about your score. But don't worry about the utilization so much. Get out of this debt. For some people, it actually makes sense, and this is the one that turned, like, this is the head twister, okay? For some people, it actually makes sense. If they have, let's say, a car loan with $20,000 of debt at 10% interest, and let's say a credit card with $10,000 of debt at 15%, usually it makes sense, okay, let's pay off the credit card. It's a smaller balance and it's a higher interest rate. Like, it makes sense to pay that off first. And yeah, financially, that makes a lot of sense. But a lot of people get in that situation where they pay off their card and then they respend. So for some, it actually makes sense to pay the car loan off first, even though that means they're paying more interest on their credit card. But guess what you can't do really easily with your car? It's really hard to take your car and swipe it on Amazon. You'd have to go to a bank and do an auto refinance and do paperwork, and that process is so punishing you probably won't do it. Instead, you got a paid off car. It's so hard to swipe the car. So think about your personality when it comes to getting into debt again. All right, so we got that out of the way. Let's get on to the next one, number 3. All right, big mistake number 3, and a lot of folks do this, and it's totally normal because there is so much pressure not to get into credit card debt, and what happens with that is we never end up building our credit. That's a really big mistake because in America, you need credit to make money and to save money. So I personally recommend, if you don't have credit yet, consider opening something like a Discover It card, or heck, you know what? I don't even know if I have it here. Do I have it here? Oh, I have it here. You get yourself the Apple card. Wait, we need music. Get something like the Apple Card. The Apple Card is an unsecured credit card. They have very, very low credit standards to get it. It kind of means anybody can get it, which is a good thing. It's really easy to pay off from your phone if you have an Apple Card. Otherwise, get like the Discover It card or whatever. And at least you start building your credit. So important. Pay it off twice a month, and then you get to do this. That sounds more bad A than my hammer. Number 4. Delaying real estate ownership. This is a huge mistake. Many wait until they're 40 or 45 to buy a home. They wait for the perfect house and the perfect kids and the perfect family, and they realize perfect never comes around, and it is a horrible mistake to delay buying real estate. Because think about this. The fact that in America, you could take, and really in other parts of the country as well, sometimes a little harder, in different countries, sometimes it's a little harder, but realize this. In America, you could take $10,000 to $20,000 and buy a house to live in. You could buy a duplex, triplex, or fourplex to live in, rent out the other rooms, rent out the other units. It's way easier to do it before you have kids. Trust me, I got 2 kids. It's way easier to move before you got kids, okay? Because before you know it, you got stuff like this sitting around in your drawers and you don't even know why, okay? But at least I got a star. Okay, realize this too. When you take a $15,000 down payment, you can control a $300,000 property with that money. So if property values appreciate 10%, you literally just doubled your down payment in net worth. You took your net worth from 15 grand to $45,000. Now, obviously, there's more involved here. You could get a good deal if you need to sell. There are selling costs, but getting a below market value deal and holding it or selling it to the tenant in the future is a great idea. And you got to know how to properly screen the tenants. And you know what? I did a complete guide on this for free. Obviously, you could join my real estate investing course that goes super deep into this stuff, but there is an amazing guide that if you have not yet watched it, you should watch it. And it's on how to buy your first rental property. I'll link it down below, and I'll link it up here probably as well, unless I forget. Number 5, with my hammer, number 5. Paying off your mortgage too early. Paying off your mortgage early or making an extra payment is a good idea. Don't get me wrong. But the problem is many of us do it too soon. I know too many people who just got into home ownership and they know they want to own more real estate. They want to invest in more stocks. They want to buy more real estate. And as soon as they get into their first home, they're like, all right, honey, let's go ahead and set up making an extra payment every single year, because if we just make one extra payment, that 30-year mortgage will turn into a 21-year mortgage. Yeah, great idea. No, it's a horrible idea. Because if you're planning on building your wealth, why would you pay off a 30-year fixed rate loan at like 3.25%? You should save that extra money, put it into stocks or index funds or whatever until you find another deal, and then use that to buy another deal. That's going to prevent you having to refinance and pay refinance fees and new COVID-related refinance taxes that were put into place. Ugh, no. Pay off your real estate when you're within 10 to 15 years of retiring and you want to slow down your wealth building. That's when you pay it all off. So it's all about that phases of life again. When you're in that payoff phase, hey, take all your cash flows, start paying off one property. Get that property paid off, take all that extra cash flow and pay off the next one. It's kind of like you snowball off your debt for real estate, but that comes down the road. So obviously, if you finance 100% of your first home, you probably shouldn't buy another one with 100% debt, unless you got a really good deal or you got some equity. So there are limits to all of this, right? Giving you a general perspective here. Okay, number 6. Number 6. Drop the hammer. Yeah, because this is a hammer dropper here. Not investing in the stock market. So many of us, and I get it, hate the idea of investing into stocks because we hear those horror stories of people that saw Kodak trending on Reddit, and then it's trending on Robinhood, and it's trending on the internet, and everybody dives into Kodak, and then the next day you're like, I'm up 50% on my money, and then 2 days later, you lost it all. And that's why so many of us think the stock market is rigged. And to some extent, yeah, the stock market is kind of rigged, especially with companies that just IPO'd or these SPACs that are going around out there where all these wealth funds or these hedge funds are taking advantage of, unsophisticated investors. I get it. And this is where I like to say stock picking can be psychologically toxic. It's psychologically painful. So an easy way to start is start with like a Wealthfront index fund of index funds. They literally put your money into like 10 different index funds. And I'm not sponsored by them. Go to Wealthfront, use somebody else's referral link. Like I don't even have Wealthfront linked down below. Go to Wealthfront and they put your money into an index fund of index funds and you could automatically put your money in there. That exposes you to like everything. It's a great way to start. Now, something else that you could do as well if you want a little bit more control is you can open up an M1 Finance account if you want. I've linked a few different ideas for M1 Finance for you down below. Here's just an example of one of them. This is the 1337 V3 index. It's something that I threw together. You could literally throw this together too. You can do whatever you want with this. I love it. But when I put money, let's say I put $20,000 or $10,000 or $1,000 into the 1337 index with M1 Finance, well, this gives me a collection of somewhere around 42 stocks. Tesla's the biggest one. Then I get Amazon, Apple, Redfin, Etsy, Dave & Buster's, a lot smaller, PayPal, Lemonade, Wayfair, Blizzard, AMD, Chipotle, Disney. Anyway, you get the idea. And the cool thing about this is it really allows me to have a lot more diversity. And you see just in the last quarter, it's up about 7%. Obviously, no guarantee of what it's going to do in the future. Some things are down, some things are up. That's just the nature of having an index. But it gives you a lot less chest pain than focusing just on one stock. And it's like, oh my God, the one stock that I picked is sucking, because that's a bad feeling. All right, next, let's get on to number 7. Number 7. Many say that it's a mistake not to invest in a Roth IRA and maximize it. And I like to put an asterisk on that. In my opinion, it's a mistake to delay buying real estate because your money is tied up into a Roth. Buy real estate first. Once you start owning real estate, in my opinion, I love the Roth. Once you get into real estate, buy into the Roth, maximize that, pay your taxes, put the money into the Roth, and grow that money tax-free. Remember, the Roth is a retirement account that allows you to grow your reserves, which I use for real estate reserves, allows you to grow your investments tax-free. And the cool thing is, if you need to take some of the money out that you invested, you could take the money that you invested out tax and penalty-free. That way, you're just leaving the gains in there to grow without getting taxed. Really cool strategy. Obviously, there are limits on the Roth. Number 8, invest every single time you get paid. Every single time you see your paycheck hit your bank account, you should ask yourself, what can I do to invest right now? Let me ignore what everybody else is doing. Let me ignore what all the hot trends are right now. Forget about what the latest hot stock is or whatever. Forget about all of that. Just get in the habit of every time you get paid, invest. I look at my money when it comes in, I'm like, spend it quickly. And I spend it on stocks, and it makes me really happy. Notice I didn't say put your money into a high-yield savings account. I personally despise savings accounts. They create a false sense of security because they create this comfort zone that teaches you not to invest and not to focus on building your wealth or building your income. So what I like to do is put 2 to 3 months of expenses as an emergency fund into your checking account. Beyond that, literally everything else goes into Roth, 401k, real estate, and stocks. That's because when things hit the fan, you got a hammer. And you have these investments as a real emergency fund, and it's going to be a real emergency fund because you're not going to want to sell those unless you really have to, where you could go in, break the glass, and take some money out as a real emergency kind of fund. If you blow past your 2 to 3 months or whatever. But the cool thing is, you tend to build your wealth much faster, and emergencies don't often come up. So in my opinion, when you have your extra savings in investments, you tend to build your wealth more over the long run. What I like to look at is the fact that 7 out of 10 years, if you do this, your stocks are probably going to be a lot higher than what your savings would have been. Yeah, there are going to be some years where it's a little lower, but as long as you have that faith that in the long run, America's going in the right direction, boom. Next, number 9, focusing on income growth. What can you do to increase the value you provide to the world, even if this means getting educated, spending some money to get a license, like becoming a licensed contractor instead of a handy person, or becoming a lender, or being a real estate agent. Heck, start a side hustle like a 3D scanning business. Maybe you join the YouTube course I have below to help you grow a business and learn how to increase your income. Try some different things. Try to increase the value that you can provide. Speaking of which, number 10. If you create a side hustle, you might have the opportunity to write off some of your expenses. So for example, this Thor's hammer here is a prop for my real estate set. So when I spend $20 or $30 on Thor's hammer, I get to save somewhere around $10 to $15 in taxes. And I like that. So I like having a side hustle that, and always verify this with your personal CPA, not any CPA, your personal CPA, because they're gonna help you deal with all of this, make sure everything you're doing is above board. But the bottom line is, if I need a new iPad because I gotta have it to help me figure out what my next note is that I gotta talk about, well, I'd like to be able to buy an iPad for my business, and if that's gonna give me some tax savings as well, makes it a nicer looking iPad. So there you go, folks. There are 10 very, very, very important money mistakes to avoid and money things to do. Thank you so much for watching. Get yourself the Apple Card. I'm not even sponsored by Apple. Get 2 free stocks with Webull. Get your life insurance in the link down below in as little as 5 minutes. Check out the courses in the links. And folks, we'll see you next time.